Okay, there's one mistake we see newer traders make every single day, and it's draining their P&L. It's avoidable, it's costly, and it's probably hurting your trading too. I'm Mike Bellafiore, co-founder of SME Capital, one of the top proprietary trading firms in the US with multiple 7 and even 8-figure per year traders on our desk. If you're serious about trading, you found the right place to learn. Let's fix the mistake that's killing your edge and start improving your P&L today.
So this is a pretty controversial subject, and I'm ready to get a lot of hate mail about it, and that's fine. The comments might blow up and people might say you're crazy, and that's perfectly fine too. But this is just an experience that we've seen from traders on the desk and traders that we know. And I think it's important to make sure that people are aware of the power of this concept that we're talking about. And imagine you're trading next to somebody and you guys are watching the same tickers. You're in the same setups and taking the same trades. But what if I told you somebody's finishing the day plus $1,200 plus $2,000, whatever it is, and you're only walking away with like $500? Same edge, wildly different outcomes. And what's the difference? It's not really intelligence. It's not discipline. It's this one mistake, and I see it kill more P&L than anything else. Let me show you what it is and how to fix it. So the big mistake is most traders, most developing traders fall into this trap. They start with static sizing. They risk the same amount on every single trade, whether it's an A+ setup or a C setup. They're not even confident in the C setups, and they're still risking the same as they are in an A setup. They treat like a really clean VWAP reclaim the same as like a trade on a breakout of a midday chop fest, right? But on our desk, every trader who scales learns to shift, to size dynamically, to press the gas when the edge is real, and then kind of sit back and coast a little bit when it's not. This example happened today, which is why we're making this video. And it was such a powerful concept that I wanted to take time to scope it and then present it to everybody here. You're going to have to stick with us through this story a little bit, but it's a really good way to do this because Sam and Jack, we changed the names to protect the innocent or whatever that statement is, but both of them were watching the same stocks. There were 3 opportunities today. Both of them are on the same team. They both learn the same setup, which we'll talk about, and the specific trades we'll talk about. But today, Sam walked away with like $1,500 or something like that, while Jack was walking away with like $300. Same traders, same ideas. One of them's making a big mistake, and he came to me and talked with us about being so frustrated about it. But we have to take a moment to compare the two and learn exactly what we're talking about. So in our pre-market planning, and this is a best practice for anybody trying to grow in their trading. In your pre-market planning, we were talking about, okay, what if NVIDIA breaks 125 to the upside? Positive catalyst in the stock, really important key level in the stock. What happens if it breaks 125 to the upside? It's a really good setup coming in. It has a positive catalyst and it's into a key resistance area on a higher time frame. One of the traders on our desk was saying, one of the traders we're talking about was saying, okay, I want to risk in this trade. I want to have my risk. I'm going to risk $200 in that trade. Great. That's a good trade. That's a good risk for that person. The other said, I think this is an A version of this trade if we get volume and if we get a clear pre-market high break. That's an A version of this pre-market high break trade. I'm going to risk $300. Both of them wanted to take the trade, right? One of them said, I'm going to risk $200 because that's what I risk in the trade. The other said, these variables define why I want to increase the risk in my trade. And don't get me wrong, it wasn't like he was going from risking $200 to $2,000 in the trade. He was risking 50% more. As this trade played out, as soon as we got that pre-market high break, let's just assume they had the exact same entry with the exact same stop. For a pre-market high break, you use the low of the day as the stop. So you can see the exact same stop, each of them is risking against that moment in time, that spot, right? So they're each risking against there. One of them is risking $200, one of them is risking $300. Let's assume that they use a momentum exit, which is a good exit to use on a pre-market high trade. You see that real acceleration, and then you see the bar break to the downside. You get a 2-bar trailing break. As soon as that occurs, that's where we take our exit. Let's look at how much one trader made versus the other trader, simply because of that little step that they took from being static with their risk to dynamic with their risk. These traders were taking the exact same trade. They were taking a break above a key resistance level on a higher time frame with a positive catalyst. That's the setup that they were trading. A break above a higher time frame level with a positive catalyst. Pretty straightforward setup, right? And then the trade they were taking or making was a pre-market high break. Pre-market high break is a momentum trade. You only want to take it when something's breaking a key level on momentum. And you want to use a momentum exit. You could argue that you could have traded this for longer and held it for longer. That's outside the point of this discussion. But let's assume they did the exact same thing. One of them recognized the need to be dynamic because he recognized it was an A setup. And the other one said it's a B setup or my baseline risk of that's all I'm going to risk in every single trade. You can see how this is going to quickly start to add up. But let's talk about 2 other examples of really good trades. And let's showcase how powerful being dynamic with your risk allocation can be. Let's talk about a second chance scalp that occurred today in a stock that had just awful news, just horrible news. It was a gap below 52-week lows, so a gap out of below any key support area on extremely negative news, right? They were talking about different trades that would present them opportunities. It's after 10 o'clock at this point, right? So you could see a big dog consolidation to the downside. You could see a VWAP continuation trade possibly to the downside. You could see an offside scalp to the downside. You might see, a second chance scalp, which is actually what we're going to see here. As the stock rose quickly into a potential area of resistance, you can see kind of that 330 area, traders were looking for a possible turn. One of the traders was saying, I like this setup and I like this trade, and this trade is a B plus trade for me. An A trade would be a big dog consolidation all below 330, but the stock wasn't really offering that, right? The first trader traded it with his standard $200 worth of risk in the trade. The second trader said, I think it's a little bit better than baseline, just a B plus, not an A. I'm going to risk $250 in this trade. So instead of being static with their risk, they're being a little bit dynamic with their risk, right? So instead of risking $200, trader A, we're going to risk $250, our second trader. The target and the exit can be exactly the same. Went down, cover half into that prior low. After you take that entry, your stop goes right above the highs of that area, which also, the reason why it's called a second chance is because it drives right up into that area that was key support before. Now it's resistance. You see the turn on the tape. You take that short. You allow that price action to look for the lows. You cover half there, trail the rest. Let's assume that they use the same exit strategy with both. You can see the gap in the P&L start to widen even more. It's these little subtle shifts that help you transition your trading so much. I think people overthink a lot of this stuff and tend to think if I'm being dynamic with my risk, that means I'm risking either 100 or 1,000. No, it's these little subtle shifts at first that then get magnified over time. This is our third example for our 2 traders, Sam and Jack, right? Jack is going with his normal $200 worth of risk looking for this breakout, this range break to the upside in a stock that had another positive catalyst, right? He's looking for this to start to trend. And he says, I'm risking $200 in this trade. I'll risk $200 against that consolidation, right? It looks pretty good at that point. Volume's coming in, looks like it might break higher and continue. All right, he enters the trade. Our other trader says, you know what? I don't like the wideness of the range. Instead of risking $200, I'm going to risk $150. Same stop. He just didn't like the way it kind of went up and tried to break, but then paused a little bit before. and the time of day was a little weird and the consolidation before is a little bit choppy, it already failed once there and kind of rolled over and then rebid it. It's just not really trading in a fluid way that feels that great. They both take the trade. Both of them lose, and let's assume they lose a full stop in that trade. One of them's down 200, one of them's down 150. They could both be down 200 for all I care, but let's assume one of them's down 200 and one of them's down 150 when they get stopped out of that first trade. This is where the biggest gap occurs. They then turn around, and this trade sets up in a very nice big dog consolidation. You can see the price action start to wedge there. You can see how tight it gets. You see that clear high where we bought before and then got stopped out on the low. That becomes our new entry point on a break above there with volume. How much more do you like that second trade? Did it go from a B trade or a B minus trade to all of a sudden a B plus or an A trade? Let's assume it's an A trade. And let's look at our two traders again. One of them's risking $200 in that trade because that's what he risks. $200 against the lows. The other is risking $300 in that trade. He risked $150 before, and now he's risking $300. It's the exact same trade. It's just better than it was before. So why would you risk the exact same amount in that trade? The consolidation got tighter, it got cleaner, time of day was a little bit better, the volume increase was significant. That's a better trade. When you take that trade, and even if you just hold that trade until you get a distinct and clear break, and let's assume that we take our exit somewhere at that 253, right? Let's look at the gap in the P&L that occurs with those two traders. This is where that dynamic bet sizing really starts to accelerate. This is where being a little bit dynamic with your bet sizing really starts to magnify the outcome of your trading. We've talked about 3 different trades here. One of them we've treated as a true momentum trade, one of them is a trend continuation trade, and one of them is a trending trade. And in it, we've actually highlighted 3 different exit strategies. But this video isn't really about those trades. Those are trades you'll find in each of these setups. This video is all about being dynamic with your risk. And we're not asking or challenging anybody to do a massive shift. We're talking about subtle shifts magnified over the course of even a single day and how that changes the dynamic of your trading over time. So the reality of this entire situation is Sam doesn't size randomly. He follows this simple model that we teach at SMB, which is a risk tiering model. So your A plus setups get the most risk. Your A setups get really good risk. Your B setups are your baseline risk. And your C setups, you might size really, really small, right? And we're not talking about giant shifts when you start, just subtle shifts that you're going to make over time. The best way that you can do this is very simple. You're going to go and study 20 examples of each trade that you have in your playbook. And if you need trades, if you need to learn more about what trades actually have edge, you can check out this webinar on the Scalp Radar. It gives you 5 trades that you can learn, and then you can go study those exact examples. You can take 20 examples of those trades, and you'll understand the difference just by those 20 examples of A versus B versus C versus A plus, which is our favorite. Once you've done that, then you can dynamically start to adjust your risk in a subtle way, and you can start to be the trader that you want to be.